Michael Ball, one ETF you like over at Weatherstone Capital Management is the Vanguard Health Care ETF. It's ticker VHT. Now, healthcare has led the S&P over the last 4 years. Why do you think this can continue?
Sure. Despite the fact that healthcare has been an outperformer for several years, it still has a number of factors that are going quite well for it. One, it's continuing to have very strong earnings growth. It's projected to be the second fastest growing sector for the 10 majors in 2015. Also, when we look at revenue growth, we haven't had cutbacks into the Medicare spending as big as what had been expected. The demographics remain quite positive, and when we look at the cash flows that have been moving into healthcare, it's remained consistent for quite some time. So it still continues to be something that can have some room to run in the market.
And you're also bullish on the Power Shares preferred stock ETF. Pays around a 6% dividend. I guess if you're worried about growth going forward, this is a good one to have.
Yes, if a person's looking for income and trying to be a little bit more defensive, this is a way to generate a pretty reasonable rate of return without taking on some of the regular stock market risk. When we compare the preferred stocks to some of the other alternatives such as utilities, to REITs, to corporate bonds, they're typically yielding more in a 3.5% range. The yield's quite attractive. Also, it benefits from the strength that we're seeing in financials. Financials are projected to have the strongest earnings growth of any major sector in 2015. Bank balance sheets are becoming stronger, so you have good strength coming from the financials, and it's been able to perform well as interest rates have been moving higher in recent weeks in comparison to some of the other more interest-sensitive areas.
Here's a fun one. You like the hack.
Yes.
This is the PUREFUNDS CYBERSECURITY ETF. This thing's up around 23% year to date. It just started back in November. I think it has $750 million in assets so far. Why hasn't this come too far too fast in your opinion?
Well, it has grown quite a bit. It's one that we have owned for several months, and frankly, as we see some of these big name hacks happening in terms of corporations or the federal government, it does tend to bring increased awareness to the area and pushes more money in there. So in the short run, it may have got a little bit ahead of itself. But it is a very fast-growing industry within technology. As the costs to repair damage from these data breaches increases, companies are willing to spend more money to essentially defend against possible data breaches in the future. So we like it from the standpoint of it continuing to attract a lot of interest and a lot of growth from companies to increase their defenses.
And then finally, you're a fan of the PIMCO Enhanced Short Maturity Fund. This is the MINT, M-I-N-T is the ticker. Why is this the best way to play it safe?
For us as a tactical money manager, where we're seeing some increased risk in the market, as we look at taking some chips off the table, so to speak, if we're going to park money for a little while to earn better than essentially zero that we're getting in a lot of money market funds, something like the PIMCO fund looks fairly attractive because you're picking up almost 0.75% in terms of the yield. The portfolio has a nice credit quality to it. It's primarily investment grade, very short term, so it's going to have very minimal impact if interest rates increase over time, and it has good liquidity. So at least you're getting paid a little bit of something while you're waiting for some opportunities that arise in the market.
All right, thanks for coming on.
All right, thank you, Greg.
Thank you for watching The Street.